Welcome back, everybody. While we're discussing the topic of the property price crash. In this week's episode, we'll talk about how a crash normally unfolds. Let's talk about crashing. How does the crash normally unfold so that we can start to pick apart the property price crash and what we'd normally expect to see?
Back in 2008, because I wanted to sort of predict what was going to happen in 2012, 13, 14, I started reading a wonderful book by my favourite economist, John Kenneth Galbraith. And this book is called The Great Crash of 29. And one of the first things that I realised reading through this book is that all crashes seem to result from different causes. Because if you could predict them from the cause, then everybody could mitigate the effects. And so very often, many people don't see the crash coming. In the case of COVID, nobody did, and nobody could have been expected to. Nobody could possibly have seen that one coming. So there are external causes which are different, but they all sort of play out the same, because then what kicks in is that governments in particular have to, it's like you've dropped a big rock in the middle of your little fish pond and the ripples are spreading hastily outwards. Well, you need to kind of calm it a bit. And so the government needs to pour soothing words and sometimes, if it's bad enough, soothing measures to try to calm things down. And as soon as you can calm those waters, which do ultimately calm themselves, your pond, when you drop the rock in, will ultimately the ripples will stop. But the government tries to stop it faster, and they will do the same kinds of measures every single time, I think.
Okay, so what we're saying is the government will intervene. The market, being the market, will probably play the government to extract a little bit of revenue, extra revenue out of them. I mean, do we normally see mortgage availability decreasing? Because, I mean, we've gone through a period when the debt of the UK has risen to an all-time high. We've never seen that. So we're burgeoning with debt. Does that mean mortgages are going to dry up because we've given it all out in bounce back loans or Sybil's loans or coronavirus business interruption loan scheme loans?
There will be. I mean, we've seen effects on the balance sheets of the banks as they've been declaring their results. So these guys are feeling some pain. On the other hand, they love mortgages because what could be better than something that is secured on an asset like property. I mean, I think banks probably prefer mortgages to loans to businesses, because at the end of the day, you just repossess that bricks and mortar property, which will never be worth zero. And so it's quite a low risk loan for banks, but they will certainly have to take a view because they've got to think about their stakeholders. Obviously, they've got to think about regulation, and in times of trouble, it does become harder to get money. And if it's harder to get a mortgage, and if valuations are starting to come in low from the professional people like Rick's, for example, then we're going to see lower offers coming in for properties, and fewer offers, I think, as well.
Okay. So with lower offers coming in for properties, that sounds like buyers are starting to lose a bit of confidence. Is that what you think? I mean, do sellers think the same?
That's always an issue in crashes, and it's always the same kind of thing. So the buyers are very fickle, and they will, at the first sign of trouble, stop buying or make much lower offers. But vendors think that conservatory out back cost me £30,000, so I'm not going to accept a penny less than £30,000 more than I paid for the property, even though I only bought it last week. The vendors have an expectation of the value of their property, which is very difficult to dislodge. So in the first instance, estate agents will continue to take on instructions from vendors at the sort of prices that the vendors think are reasonable, which might be the prices that the property would have got last year or 6 months ago, or whatever. Even though the agent feels that they really don't have much chance of actually shifting this inventory off their books, and then over time the vendors will come to realise. And then what they'll do is, in an affluent area, they'll just pull the properties off the market and that's it, and they just sit on them for a few more years. But there are always cases where people need to sell. In poorer areas, they don't have that luxury of being able to do that. And so there are other factors at work here which, even in an affluent area, might cause people to wish to sell their properties sooner and not be able to ride out the storm, if you like. And I think there's this thing, isn't there, called the 3 Ds.
Yes, debt, death, and divorce.
And in all three of these circumstances, people are usually, because, for example, they've got death duties to pay, or, for example, because they've got bills to settle, or, for example, because the former family home needs to be sold so that the two individuals who are no longer willing to share a roof together can go and make their own plans. These need to be sold come hell or high water, and so they are going to go for lower prices, which is going to feed back into land registry data, and which is going to have an overall effect of pushing things down a bit. But, what comes down always goes back up again, and we always stay on that long-term trend line, which tends to mean that over the course of an entire property cycle, which is usually about sort of 18 to 20 years, over the course of that cycle, on average, properties roughly double. So it's not all doom and gloom here.
Okay. So what we're saying is prices and volumes of transactions are potentially going to fall. But, I mean, I'm aware of areas, and you're aware of areas that have bubbles around them. Bristol, Cambridge, certain parts of London that defy gravity sometimes, and defy the rest of the market. So, I mean, surely that won't be impacted, or will it?
There's the old saying, what goes up must come down, and you have to look at the reasons why in some of these areas property prices have gone up. It might not be so much due to the fundamentals as to speculation. I mean, to take my home city of Cambridge, for example, we've got a lot of high-tech companies. When I came here, I think we had a single-digit number, 8 or 9 or something. We've got about 20 now, multi-billion pound startups that have come in here in the tech sector. We've got Microsoft and Apple, both of whom have got a major presence in the city. They both got buildings here and so forth. So speculators think, hey, it's kind of quite a cool place to own property. And in a lot of cases, new developments in Cambridge have been sold, for example, at a presentation in Beijing to overseas investors who are told Cambridge is just a suburb of London. On that basis, the development 100% sells out. So people like this might not want to keep their money in the game if they perceive there's trouble brewing. So where the property price has gone up, not due to fundamentals, but due to speculation, there's a chance that these guys who or girls who may be quite fickle will pull their money out to invest elsewhere in the next new fad.
Thank you for joining us today in the discussion on how a market normally crashes. Now, David and I have in our next episode what the government have done and can do and should do to prevent another crash or limit the effects of the next crash. So it's goodbye from me, Andrew Roberts.
And thank you from me, David Clouter. We hope you'll join us again next time.
And we are the Professors of Property. We look forward to seeing you soon.